And in this webinar, we want to talk about the idea of using what we call relative aggression bars to make better trading decisions. And just to give a bit of an overview, I want to touch on a major difference between winning and losing traders, and then really get into the idea of how aggression works, how it really moves the market, and then talk about how you can use these relative aggression bars to see aggression in real time. And finally, we want to get into some real detail, show a lot of charts and examples about how you can use this concept of aggression to make better trading decisions, to see the market more clearly, talk about the roadmap concept that I really like, and then show also, really hone in on 4 really high probability trade entries using this idea, as well as talk about exit decisions, and then talk about a really interesting idea that we call Confluence. And then at the end also, we're going to have some time for some questions and answers. So I would recommend, if you do have any questions, first of all, if you have a thorough question, you can always send an email to info@daytradethemarkets.com, or at the end we will have some time for Q&A. So with that said, let's jump into it. But before we do, just really brief about Dave and myself. Dave has been trading for 30 plus years, is really an expert in market auction theory, just a great educator. And I met Dave 5 years or so ago. I've been trading for 10. The first 5 were pretty rough, and I can tell you some stories, some horror stories. And if anyone's kind of going through that right now, certainly I would be happy to get on the phone with you and explain, because I've kind of seen it all. But really turned the corner thanks to Dave's mentoring and Dave helping me understand the market better and understand how to really think like a better trader. So just a brief about us. I'm certainly, we're happy to talk in depth at a later time, but I want to kind of get into the meat of it here. And one of the things we want to touch on here is a major difference between winning and losing traders. To us, our opinion, we look at your job as a trader. You might think of it as, well, your job is to buy and sell and to make money. We look at trading as you are a professional decision maker, and what your job is to make the best possible decision based on the information that you have at a given moment. And the way that you become a better decision maker is with better information, better education, better knowledge. With that, you can become a better decision maker. And if you can focus on making good decisions, and you can do that time and again, it will lead to good results and profits. So in other words, winning traders, and we talk about this all the time in our training and in our videos and in our member sessions, winning traders really focus on process, or in other words, making the best decision at the moment, where losing traders tend to focus on the results. Am I up for the day? Am I down for the day? How much profit do I have on this trade? How do I make the most in this trade? It's money focused as opposed to decision focused. That's a kind of a subtle point, but I think it's really important. We wanted to hit that early on because I think it's so important, and that's one of the major lessons that Dave taught me several years ago. That's really helped me turn things around. So, that idea of being a decision maker, you need better information. You don't just need a lot of information, but you need better information, and you need better information. So we look at that as a kind of a 2-step process. Number 1, get clear on what actually moves the market. And then number 2, determine how you can see that information more clearly. And what really moves the market is when one side, whether that's buyers or sellers, is more aggressive than the other. And we have a tool called relative aggression bars that can help you see that in real time. But instead of having all of these, so many people use so many different technical indicators and different tools, and I'm not saying there's not a place for that. There is a place for that. But in our opinion, it makes the most sense, and you get the most clarity if you can really hone in on what really moves the market, and that is aggression. And so that's what we're going to focus on here today. So before we get into some examples, let's talk about what is aggression and why it moves the market. And to do that, you may have heard in the past, or some of the talking heads on TV, or you see in the newspaper that don't know as much. You may have heard the concept, well, the market went up today because there were more buyers than sellers, or the market went down today because there were more sellers than buyers. But if you think about it, that is not accurate. By definition, every time there's a transaction, there's both a buy side and a sell side. So anytime it's not more buyers or more sellers, it's when one of the sides is more aggressive than the other. So what actually moves the market, in this case, if the market moves higher, it's because buyers collectively are more aggressive. Or if the market moves down, it's because sellers collectively are more aggressive. Okay? So To illustrate this, let's use kind of an example that we're probably all familiar with. We probably all bought or sold a car at some point, or it could be a bicycle or a house, or it could be anything. Just want to use kind of a general example. But let's say that you are in the market for a car, and Bob has a car that you want. He's asking $20,000 for the car, but your price is $19,000. You only want to pay $19,000, okay? And for the sake of this example, I know in real life you would probably you and Bob would negotiate to 19.5, meet in the middle, you'd all be happy, you'd drive away. In this case, let's just assume for the simplicity of this example that you can't meet in the middle, and the car either has to be sold for $19,000 or for $20,000. So as a starting point, what would happen if neither one of you is willing to budge on price? In other words, you won't come up from 19, he won't come down from 20. What happens is there's no deal. There is no market for this car. You know, in other words, Bob here is asking $20K, you're willing to pay $19K, you see you're not connecting. There is no transaction, there's no deal. In other words, the market for this particular car does not move. Nothing happens. Okay? Now, let's take another scenario. What if you really want that car? What if you were afraid, and this is an emotion that we face in the markets all the time, what if you were afraid that you're going to miss out? Well, if you're afraid you're going to miss out and you really want that car, you're afraid someone else is going to come grab it from you, then you need to get more aggressive. In other words, instead of being willing to pay $19,000, you have to basically pay up to Bob's $20,000 asking price. So you come up from 19 to 20. In other words, you as the buyer is more aggressive. And because you were more aggressive, you were willing to step up a transaction, the market for this particular car moved. You were more aggressive, a transaction occurred. Now, on the flip side, what if Bob really wants to sell the car? What if he, again, is worried that he's going to miss out? What if he's worried that another buyer or a better price is not going to come along? Well, in that case, Bob has to become more aggressive. He has to kind of accept down to your $19,000 offer. So he has to come off of his $20,000 price, and he has to drop down to $19,000. And again, Bob, the seller, was more aggressive. So a market for this particular car, a transaction occurred in the market for this particular car. The market moved. The price went down. The seller was more aggressive. The price went down. Okay? So that's a pretty easy, simple example. Hopefully that made sense, and I'm just trying to give a very simplistic example, and I hope you understand that, but the same principle would apply in the markets. Okay? This process literally is happening in the electronic markets of today, is happening hundreds of times per second. And again, if collectively buyers are more aggressive than sellers, price is going to go up, and if collectively sellers are more aggressive than buyers, price is going to go down. So again, aggression moves the market. And so the next question then becomes, how do you see, or how can you see aggression in real time? In other words, how do you identify the aggressive side in real time? So the way we look at this is that the first priority is that you have to determine which side is more aggressive, because again, if buyers are more aggressive, it's going up, and if sellers are more aggressive, it's going down. So if you can determine which side is more aggressive at a given time, you have a bit of an edge. And there are tools out there that can give you this raw information. What we've done, and I'll show you in a bit, is we've kind of taken that idea and taken it to the next level, kind of put it on steroids, if you will, or what's Lance Armstrong on, or what was he on, EPO? We're taking it, put it on EPO. So the idea is we've added not just this raw order flow information, we've also added some volume information, some range information, some velocity type information. So not only are you able to tell which side is more aggressive, but then the second priority is we want to determine to what degree that side. So to what degree are sellers being more aggressive? Are they moderately more aggressive than buyers? Are sellers strongly more aggressive than buyers? Or are they extremely more aggressive than buyers? So we want to add a relative component to that. And then it's also important, again, when the markets are moving, there are times when you have to make quick decisions, and you need to be able to see this visually in a very quick, clear, powerful way, so again, that you can take action, get into more good trades, avoid more bad trades. And one way that you can do this that's pretty clear is this concept of relative aggression bars. So let me explain that a bit. We've been through this. The market moves when buyers or sellers are more aggressive than the other. And so what we're trying to do, again, is, number one, determine which side is more dominant at a given moment. And then number two, we want to see to what degree that side is more dominant at this given moment. Okay, so we want to really see under the surface of the market. price is kind of above the surface. That's what you see. We want to see what's going on under the surface. We want to see the order flow and some other factors, some volume and some velocity type of ideas. We want to see what's going on under the surface so that we can better, instead of just seeing what has happened, we want to better be able to predict what will happen. And we also want to see what's happening right now. Okay? So there are 3 levels of these aggression bars. The first is a level 1 aggression bar, and this is telling us that there is moderate buying or selling aggression. So we have a buying level 1 bar and a selling level 1 bar, and you can change if you have any issues with these colors. These are all changeable. There's audio alerts that go along with that, of course. Now these level 1s are going to occur. This is a rough number just based on the different market and time frame, but roughly 15 to 20% of the time. Then we have a level 2 aggression bar, and that's telling us there is either strong buying aggression or strong selling aggression. Those are a little bit darker colored, and that's more rare. That's going to happen only 2 to 4% of the time, depending on the market. And then the extreme buying and selling aggression is what we call level 3, and that's again more rare. But this is something you absolutely want to pay attention to. I'll show you some trade entry concepts based on just these level 3 bars in a moment. Excuse me, but the idea here is when we have a level 3 bar, that's typically either the start of a vertical move, or it can be capitulation and the end and the start of a reversal, the end, kind of the end of the road sort of idea. And I'll show some ideas on that. Now these relative aggression bars kind of act as a roadmap to the likely short-term market direction. Because again, if you can see under the surface what's really going on, are buyers really aggressive? Are sellers really aggressive? That's giving you a bit of a roadmap. So there are several ways. I'm going to go through several different ways that you can use these relative aggression bars kind of in general terms, and then talk a little bit more in depth about some other ideas and some examples. But the first way that you can use this is very simply just to determine which side is in control of the market. So, for example, you can see in this example here, and just for clarification, on most of these slides, I've taken off the level 1 buying and selling bars, so I'm just showing the level 2 and level 3 buying and selling aggression bars. Those are the ones that are more rare, but they're giving you some really solid information. These level 1 bars are good information. They're nice to know. They're nice to see, but they're kind of a little bit of a heads up. These level 2 and level 3s are really powerful, and that's what you want to focus on for the majority of the time. And with the software, you can have it show you just level 3s or just level 2s and 3s or all. That's kind of up to you in terms of how you like to see things. Getting back to this slide, you can see, and hopefully you can see this slide, but the level 2, some strong buying aggression starting to come in. You get some follow through, and some extreme buying starting to come in, some follow through higher. Another extreme buying aggression bar with some follow through, strong buying aggression. Then you can see here is the first sign of some aggressive selling coming into the market with this level 2 bar. And then we have another test of the high that attracts, the price rose high enough to attract more selling. Sellers step in aggressively with this level 3 selling aggression bar with some follow through, and you can see sellers are starting to take over the short-term direction of the market. So that the first way again is determining which side is in control of the market at a given time. Another way you can do this is to identify major moves early. This, you can see from the prices here. This is the ES. You can use this on any market, but this is a little bit old. But this happens to be a 1-minute chart, and you can use this on any time frame. But this was a move a while back that we rallied about 50 points in about an hour. So you can identify major moves early. Just wanted to show kind of a major move here. You can see that that we're just kind of meandering lower with some level 1 selling aggression bars, and then off of the low we get our first sign that buyers are coming in. You can see there's follow through, more extreme buying aggression, and it wasn't until we saw the first sign up here of this major rally running out of steam. And kind of an interesting note on major moves. Hopefully this makes sense. Not every level 3 bar leads to a major move. Okay, so not every level 3 bar, extreme buying aggression or selling aggression, leads to a major move, but you will, I don't like to use absolutes, so I'm not going to say never, but just about never, you will just about never see a major move that doesn't happen with a level 3 bar. Okay, so not every level 3 bar leads to a major move, but there are rarely, if ever, a major move that doesn't incur or occur with several of these level 3 bars. Okay, hopefully that made sense. So next usage again is to identify some major moves early. Okay, another way that you can use this is to identify capitulation. And again, what I mentioned earlier was when you have a level 3 bar, it's typically either the beginning of a vertical move or it's the end of the road in capitulation. So what we have found time and again is that if you get a level 3 selling aggression bar, for example, on the low of the day, and there's no follow through and it gets rejected pretty quickly, that's a pretty good sign 7 out of 10 times or so that the low of the day is in place. Same thing on the high of the day. If you have a level 3 buying aggression bar on the high of the day with no follow through, pretty much immediate rejection, it's a very good sign that the high of the day is probably in place. And if you think about it, this idea of capitulation, it's kind of like, you know, there's extreme buying aggression going on in the high. It's kind of like if an airplane is taking off and it's ascending, and then all of a sudden there's no more gas. In other words, there's no more buyers. There's no more. It's not attracting more buyers. We run out of gas. Which way is the airplane going to go? Well, it has to go in the opposite direction. It has to go down. So that's the kind of the idea. If this is you know, buying aggression coming in and it attracts no more buying aggression, it's probably going in the other direction. That makes sense as well. So identifying capitulation is another usage of these relative aggression bars. Another way is to identify consolidation or choppy days versus trend days. And I just did a video on our site about this. If you're not on our list, by all means, go get on our video list. So you can, you know, we send out a lot of videos and just try to give education and be helpful in that sense. But the one really interesting or good way to identify whether the market is likely to be choppier in consolidation versus breakout or trend is that, number one, if there's no extreme aggression that you're seeing, that's a pretty good sign on its own. But then if you have, you know, lows or highs or you know, relatively long-term lows or highs being made on these level 2 bars, and there's no follow-through at all, there's quick rejection. You can see quick rejection of this selling bar. No follow-through on this buying bar. No follow-through lower on this selling bar. No follow-through higher on this buying bar. It's just a good sign there's no extreme aggression on one side or the other. There's no follow-through when one side does try to make a minor move. Okay? Pretty good sign that the market's in, and there's other clues that we talk about as well, but this is just, you know, talking about relative aggression bars. It's a pretty good sign that this market that's got no conviction behind it, and that you want to certainly either stand aside or employ more of a reversal fade type of strategy for that day. Now on the flip side, you can use these relative aggression bars to identify true breakouts, not head fakes, true breakouts, identify trend type days. We have other tools, but just focusing on these relative aggression bars, when you have a new high or a new low, for example, in this case, a new high made with these level 3, this happens to be in crude oil, but if you have a new high being made with level 3 bars and then there's follow-through, the low holds, there's follow-through, that's a pretty good sign that this extreme buying is attracting more buying, that bulls are very much in control. Here's another one. Every time you see a buying structure, level 2, here's a level 2, here's another level 3, another level 3. Every time there's a buying structure, there's follow-through. It's a very obvious, it's a very clear sign that we've broken out, that bulls are very much in control. You would certainly not want to be fighting that, and you'd want to find a way to go with that. Now I'm going to talk about that in a moment here. So another use is identifying chop versus trend type of a day. Okay, we have a filter that goes with that can help with that, and I'll get to that in a moment. But hopefully that makes sense. Another way that you can use these relative aggression bars is to make better exit decisions. And this is kind of interesting. When Dave and I were designing this, we didn't really think about the exit side of things as much. I mean, certainly, obviously, very focused on maximizing exits. But this was kind of a hidden benefit that we didn't really plan for when we were coming up with the logic of this concept. But what we've really found, and what people are finding, is that this is really helping you maximize what we talk about, maximizing your exit decisions. And this is, obviously, if you've been trading for a while, you know how important it is to minimize your loss on losing trades. This is how we define maximizing exit decisions, by the way. Minimize your loss on losing trades, maximize your profit on winning trades. If you can even make the slightest of adjustments and lose on average just a little bit less on your losing trades and win just a little bit more on average on your winning trades, makes a huge, huge difference over the course of a year. So what we have found, and I actually was talking to somebody just on Friday, I think, one of our clients, what he was saying, and some people run into this, is that he'll be into a trade, he'll be up 3 or 4 ticks, and he'll just bail. He doesn't want to give back, you know, what he has, and obviously that's money-based focus as opposed to process-based focus that I mentioned earlier. But and on the flip side, there are people, and this is more what I tend to fight, is you know, I'll be in a trade and I'll try to hold on a little bit too long, and I'll give back too much of my profit. So I think you know, as a general rule, as a trader, we probably have one of these two tendencies. The first way to overcome this is obviously to think more in terms of process, and one of the ways you can use these relative aggression bars to do so is to think about your exit process in this way. Okay, number one, why did you get into the trade? And if you got into the trade because you had some evidence that buyers were in control, then it would stand to reason that you would not want to get out of that trade unless you had some contrary evidence. And hopefully that makes sense. Let's just say, for example, hypothetically, we got long somewhere down toward the low of the day when these level 2 bars started to come in, okay? Just for a hypothetical. There are a couple ways that you can use these relative aggression bars to stay in trades longer, but not too long. You know, not to get out too soon, not to get out too late. You want to wait until you see, if you got in because you think that bulls are in control, then you'd want to stay in until bulls are proving they're no longer in control. And there's a couple ways you can do that. One is what we call a trailing stop. And then once you hit your first, you know, basic target, you'd move your stop to break even. And then every time you got an additional buying aggression bar like this one, you'd place your stop a couple ticks below that. Okay, so if that low is breached, it tells us that buyers are not clearly in control. That's a pretty good place to get out. The next one comes in, place your stop a couple ticks below it. Here's the next one, a couple ticks below it. Here's the next one, a couple ticks below it. And eventually you'd get stopped out somewhere in here. But that's, again, an evidence-based reason for getting out. It's not just based on a feeling. It's not just based on, oh, I hope I don't give profit back. You're waiting for the market to actually give you evidence, order flow-based, under the surface evidence that there's a reason to get out. Another way that you can do that is this takes a little bit more holding power, a little bit more stomach. You can simply wait, not just by trailing, but just keep your stop locked in at break even, and you're just going to hold until there is some follow through on a selling bar. So in this case, you get in here, you bring your stop to break even, then you're just holding until you see a selling bar that gets taken out by a couple ticks. So in this case, you had this selling bar on the high of the day. It gets taken out by a couple ticks, you get out here. Because it's the first sign, you know, this selling bar doesn't mean that buyers are going to take over the market, but it is the first sign that this pure wave of buying aggression has at least come to an end. So we're either, you know, taking a pause, we're going to enter consolidation, it's hard to tell, but at least there is some evidence that makes sense for getting out of the trade, okay? So that hopefully makes sense in terms of you know, trying to be able to hold on with evidence-based reasoning for staying into a trade. Same thing would work on the flip side, where a lot of times I think people, you know, with the idea, and it's a well-founded idea of risk management, they place their stops really tight, okay? But you can have your stops so tight that you can still, you know, be right on a trade, but you get nicked before the trade takes off and you miss out. You take a small loss, but you're not on board the train when it takes off. What you can do, and again, I don't recommend this if you're a beginner, but what you can do is place your stop a little bit wider than you might be comfortable with. You need to have some kind of protection. That way, if some kind of flash crash or something really urgent comes in, which, you know, may happen 5% of the time, you might get stopped out before you're able to react. At least you're protected against the really strong downside. But what you can then do is kind of leave your stop a little bit wider, and then have the discipline that if some contrary evidence, so again, let's say you get in, let's say you get long somewhere in here, you might want to place your stop a little bit wider than you'd be comfortable with, but you have to be willing, if there's some selling evidence that comes in, that you'll just bail, okay? So again, you minimize loss on losing trades without having your stop so tight that you end up costing yourself before you are actually wrong. Okay, hopefully that makes some sense. So next, another way that you can use these relative aggression bars, and I really like this concept, I call it the market roadmap. We kind of ask ourselves a basic question when you have a level 2 or a level 3 buying or selling aggression bar. when one of those forms, we ask ourselves, is there follow-through or is there rejection? Okay? If there's follow-through, we would expect the market to continue in that direction. If there's rejection, we would expect the market to go in the opposite direction in the short term. Okay, so as an example, if you have a selling aggression bar, the first question that we're going to ask is, does the high hold? Okay, if it does, that's sellers are still in control. If the low gets taken out, even better. And conversely, with buying aggression bars, does the low of a buying aggression bar hold? And then can the high get taken out? So for example, hopefully you can see my cursor. We have this level 3 selling aggression bar. Does its high hold? Yes. Does its low get taken out? Yes. Okay. Short-term sellers would be in control. Here's another level 3 selling aggression bar. Does its high hold? Well, actually it does. Did the tick. As that's being tested, we have a level 2 buying aggression bar. Does its low hold? No. Okay. Sellers are in control. Buyers could not take over. Here's a level 2 selling bar. Does its high hold? It does later, but its low was taken out. Then the high was tested. It maintained. Sellers are still in control. Okay. Here's a level 3 selling aggression bar on the low of the day. And we talked about capitulation on the low. Does its high hold? Well, it bounces a point and a half, but then it gets ultimately taken out, and the low could not be taken out. Then you can see some buying aggression starts to come in. Low holds, high is taken out. Another buying aggression bar. The low holds, the high is taken out. Here's another one. The low holds, the high is taken out. So again, you can see it's kind of a roadmap. When we ask ourselves, is there follow-through or is there rejection? It's giving us a pretty good handle on the likely short-term market direction going forward. So how can you use this? Obviously, you can use this to help you stay on the right side of the market, avoid bad trades. You can use this in conjunction with other methods you may be using and just kind of use this roadmap concept. Again, it's all about increasing your decision-making power, increasing your edge. So that's the roadmap idea, and that's a little bit complex, but hopefully that made some sense. And this is something we teach and talk about, all the time. But we're always asking ourselves: is there follow-through? Is there rejection? Okay. Now we've talked about just some general uses of these relative aggression bars, and I'm going to talk about some other tools in a bit as well. But next, I wanted to talk about just some trade entry setups. I'm going to just show 4 different trade entry setups, all just using these level 3 or extreme aggression bars. And these are just one of several trade. We have 15+ trade setups that we have in our member center. But I'm going to talk about the sweet spot trade, the level 3 retracement, level 3 breakout, and then level 3 reversal trades. But before I do that, I want to talk about, this is something that's extremely important, and it's extremely important to me and Dave to talk in these terms. This is subtle, but a very important distinction. So many people out there, and probably experience it, say, just take this trade and you're going to be great. I think that's a mistake. Let me talk about this very subtle distinction before we talk about trade setups, because it's really important to us that we talk in these terms. So I think what happens, this is what we see all the time. This is something I certainly battled for a long time, and I know that, excuse my voice, and I know that a lot of traders go through this. It's almost something you have to go through, I think, especially when you're starting trading. But so many traders are focused on trade entries, okay? And tends to be how losing traders focus. They focus on trade entry setups. So what I mean by that, and the trade entries are extremely important, but what I mean by focus on trade entries is that you'll have rule-based trade entries. Well, if this crosses over that, and then I have this bar, and this happens, and A, B, C happens, I've got a trade setup, and I take it, and I'm robotic about it, and there I go. So it's trade entry setup. So you're always looking for the latest, greatest, newest trade setup that's going to make all the difference. Winning traders, generally speaking, tend to focus, and this is the important subtle distinction that I think if you can understand, I think it can be just a really huge shift. And if you've already got this, great. But winning traders tend to focus, and this is something that we teach and we think is extremely important. Winning traders focus first on making sense of the market, or in other words, of putting the market in context. In other words, try to look at what the evidence is telling you, and the better evidence you have, the easier this is, obviously. But you try to make sense of, are bulls in control? Are bears in control? Is no one in control? Are we trending? Are we consolidating? Are we whatever the case may be, what is the market doing? Is there an edge being long versus being short? Put the market in context. Then, and only then, focus on finding a low-risk trade entry setup that fits into that market context. Okay, so hopefully you grasped what I'm saying. Instead of just taking, rule-based trade entries and saying, well, A and then B happens, so I'm taking a trade. Well, if the market context happened to be in line with your trade, for example, you may have heard you need to take trades with the trend or be a momentum trader. Great, those momentum trade setups will work great when the market is in a trend type of a situation. But if you take a trend setup and the market's consolidating, you're going to get your head ripped off, and vice versa. So if you can first make sense or be able to put the market in context, and then and only then focus in on how can you find a low-risk trade entry concept that fits into that context, you have just radically increased your edge. So I hope that makes sense, and it's really important that we talk about that before and make that distinction before we just show these trade setups. Because what I want to be very clear, we're not saying anytime one of these trade setups come in, just blindly get in. That's not, you can do that, you'll actually have a little bit of an edge, but that's not what I would recommend. I don't want that. That's not going to help you in the long run. You don't become a good trader if you do that. Hopefully that makes sense. So the first trade entry setup we want to talk about, and again, I'm just talking about level 3 bar type trade setups, is what we call our sweet spot trade. And the idea here is that when you have 2 or more level 3 bars right in a row, you want to identify the area where those 2 bars overlap. And that's kind of the sweet spot, kind of the idea where it's a really good trade entry location, because the logic behind that is, we talk about level 3 bars either being the start of something or capitulation. Well, if you have a level 3 bar and then it's quickly followed up by another level 3 bar, that means it's just attracted a lot more selling in this case. And again, you want to do this with context. We talk about other ways of putting the market in context, but besides getting into bigger picture bias and support resistance and that sort of thing, which we talk about, if you just look back at this chart, you can see we had a level 2 bar with, we're going back to that idea of the roadmap. Here's a level 2 selling bar with follow through. Level 2 selling bar, the high basically holds. Now here, level 2 bar did not hold, but then this level 2 buying bar did not hold. Okay, so the context earlier on, a little bit of a back and forth. It's a pretty quiet market, but it's generally speaking been more dominated by selling at this point in terms of our roadmap concept. And then we get this extreme buying aggression followed by another one. Where those overlap is kind of a sweet spot. Okay, so again, you want to have other contexts. You don't just want to blindly take these. But when you do find these, and they don't happen all the time, it's a very high probability trade entry type of a setup. And you can see the reasoning behind that, the logic. Okay? Next setup we want to talk about, this is probably my favorite trade, called a level 3 retracement trade. Kind of one of the first precepts or concepts that we have is that, when you have a level 3, in this case buying aggression bar, the first thing we want to talk about is, can the low hold? The logic is this was the start of some extreme buying aggression. So logic would dictate that where the aggression began, it's kind of like this is where bulls took control. The logic would dictate that bulls would kind of protect their turf, so to speak, protect this territory. And that's the idea. It doesn't hold every single time, obviously, but that's the idea. Very much more often than not, if you get a level 3 buying aggression bar, the low of that's going to hold. So again, if you first have some context that being long makes sense, and then a level 3 buying aggression bar forms, limit order a tick above the high or a tick above the low or right at the low of that bar is a very good entry, and that's what we call our level 3 retracement trade. Same thing on the sell side. Here's a level 3 selling aggression bar. Our expectation, as long as there's some context to justify this, our expectation would be that the that the high of this would hold, and that's a very high probability trade type of a setup. Again, you don't take it blindly, but if you have other context, which I'll talk about, you I apologize about my voice, guys. Sorry. The idea here is that that's a high probability trade entry, especially if you have other context. Okay, so that's the level 3 retracement trade. One of my favorite ways to look at the market right there. Here's the level 3 breakout trade. This is certainly more aggressive. And again, this would certainly, I would highly recommend you take this type of a trade in context. We'll talk about our bigger picture bias in just a minute. But if you have a situation like we're having now in the market, where bigger picture, the market is in an up auction, then if you get a level 3 buying aggression bar on the high of the day, you have a better edge in just getting long. Instead of having to wait for it to test the low, just enter at the market, get on board. So kind of the breakout trade. Again, you wouldn't want to buy a breakout if the bigger picture bias was down, but if the bigger picture bias is up and you get a level 3 buying aggression bar on the high of the day, a pretty solid opportunity. You can see later on we had another level 3 bar here. Low that was tested perfectly. Level 3 retracement, just as another example. Here's on the sell side. New low of the day is being made with level 3 selling aggression bar. If there's other context, other reasoning for doing so, that's a pretty good aggressive breakout trade. Okay, it's giving you information. Sometimes, sometimes when the highs and lows are tested, sometimes they're head fakes, sometimes they're actual true breakouts. When you get a level 3 bar on the high or low of the day, especially if it's if you can put it in context, just giving you that extra edge that this breakout is real. Okay, so that's the level 3 breakout trade. Here is another trade that I really like, and this is kind of the opposite idea. This is kind of that head fake, that false breakout. It's what we call our level 3 reversal trade. So again, you would want to have some context. So in this case, if I'm looking at the level 3 reversal short here, we have a level 3 buying bar on the high of the day. You wouldn't want to take this if the bigger picture market auction, like we're seeing now, is up. You'd probably want the breakout. But if the bigger picture market auction is down and you get a level 3 buying aggression bar on the high and there's no follow through, and then you get a full bar below the low of that bar, then a limit order toward the low of that bar again is a really nice reversal trade. Your stop can be right at the high of the day. Really nice reversal trade. You can also wait for it to test in there a little bit higher and wait for what we call a deceleration, but getting ahead of the game here, sorry. That's a really nice reversal type trade. Same thing, this would apply more in the conditions that we're seeing right now in the index markets where we're in an up auction bigger picture, but level 3 selling bar on the low of the day, no follow through, highs taken out, full bar above, look to be a buyer near the high of that bar. Really nice reversal type of a setup. Okay, so hopefully that makes sense. I just wanted to show 4 of many different trade entry ideas, but the real key point is you can't just blindly be a trade entry guy or gal. You really have to learn first and foremost to put the market in context, and that's what we really try to focus on day in and day out, is putting the market in context using really good evidence to help you do that, and then you focus on finding a trade setup that matches that. Okay? So now we've so far talked about this idea of aggression bars. That is really just kind of the tip of the iceberg. We also like to look at a lot of additional market evidence, and that's what the software shows. These aggression bars are kind of the first building block, or the first puzzle piece. But in real time, we also look at relative aggression bars, like I talked about. We have these high velocity moves, real-time support resistance zones that form, deceleration and divergence bars, which are kind of neat, a filter to help you kind of see the path of least resistance, and then, like I was talking about, the bigger picture key levels that we talk about. Because again, additional evidence, and I should probably change, not just additional evidence, but quality additional evidence gives you better information so you can make better trading decisions. So what I thought I would do is just kind of build a chart out piece by piece. We've talked about these relative aggression bars. In this case, okay, level 2 bar, level 2 bar. Here's a level 3 buying bar. Low is tested perfectly. More level 2 buying. A little bit of a back and forth here, but you can, we've talked about that. That's the first component, relative aggression bars. Then we add this idea of what we call a high velocity move, and those are what you can see in these little boxes. It's kind of it's similar to aggression bars in terms of usage. It's just another way of getting at the same general idea where we have a quick burst in the market. It's a velocity type of a concept. So we're looking for, it's telling us strong buying or strong selling. Same idea. If there's follow through, if the low holds, it's bullish in this case. If there's rejection, it would be bearish. It's a buying high velocity move. That's kind of the second piece. Okay, next is the next component would be the directional filter. This is kind of the short-term path of least resistance, and this is shown at the bottom of your chart. And this has 5 different settings or colors. It's kind of on a sliding scale. Again, you can change these colors, but bullish, strongly bullish, neutral. And again, this is just, I look at this as more of a confirmation aid, and this is important as well. With any of these tools, it's not that any one of these tools is the be-all, end-all. These tools are each these components are each giving you a piece of the puzzle, a piece of evidence. And obviously, just like if you're doing a puzzle on your table, if you, if you have more pieces of a puzzle that come together, you have a clearer picture. Okay, so this filter in and of itself not the be-all end-all, but it's nice. If you have a long trade set up and the filter's green, that's giving you additional confirmation. It's increasing your edge just a few percent. If you have a long trade setup you're looking at and the filter's red, it doesn't mean don't take it. It just means, think twice. That's kind of the thought process we like to use. So the third component is the filter. Fourth component would be the support resistance zones that form in real time. And again, the idea here, you can see there are green zones and red zones, and the idea here is all things equal, a red zone, if you have other evidence to support it, a red zone is a good place to be looking to get short, and a green zone, if you have other context, is a good area to be looking to get long. And conversely, if you have a green support zone, you'd want to think twice before getting short into that. If you had a red resistance area, you'd want to think twice before getting long. So again, you increase your edge in trade entry and exit. And again, support resistance is not the be-all end-all, but when you combine it with other evidence, you may get on our software or other evidence that you're using already, you simply have better information. You increase your edge a couple more percent. Okay. Next component here is the idea, what we call deceleration and divergence bars, and you can see those are little triangles there. Now, let me try to explain what those are. A deceleration is a case where, let's just look right here, okay? You have a bar that has a lower low, in this case, than the prior bar. And if you have a bar with a lower low than the prior bar, and the level of selling aggression, in this case, were increasing, then the expectation is that the market would keep selling off. But if you have a lower low than the prior bar, but the inside the bar aggression, the selling aggression, is drying up or decelerating, that's telling you that the market is likely to reverse. Okay? Now, another really important point here about these decelerations is these are not the be-all end-all. A lot of people see these and say, oh, great, I'll just take trades off of those. Not what I would recommend. These are additional information. They're great turning points. They're great confirmation for entries, but you want to make sure you have other evidence in addition to that. Hopefully that makes sense. So, again, you have deceleration. It's a great turning point. It's a great potential confirmation for an entry. You don't just want to take any of these things blindly. Okay? And then finally, next component, I talked about this, is bigger picture bias and bigger picture key levels. Each night in our member center, we have a full report on the bigger picture and the bias, and bigger picture bias in the market. And by that I mean the past few days, the few weeks, the few months. We talk about scenarios in which that would change. We talk about some key big picture levels, like, for example, today in our report, 1475.75 was one of our key levels. That was today. So I mean, these are, Dave is outstanding at this. He does the majority of these, and it's a really nice way to go. And again, that's in the ES. You can also use our bigger picture time frames in the same sense if you're trading other markets as well. But I just want to kind of touch on, all things equal, if you can also have the bigger picture in line with what you're doing, that's all the better. Again, more evidence, better information leads to better decision making. Okay? So next I want to talk about, and I know I'm getting a little deep here, and if I'm going too much, I'm sorry. We can obviously answer questions more fully by emailing at us at info@daytradethemarkets. But this is an idea that I love, and I want to just kind of add it in here. Hopefully it makes sense. It's the idea of confluence, and it's basically having multiple pieces of evidence come together. Like I was saying before, if you have not just one, but 2, 3, 4 pieces of evidence that all line up, you have a much better edge. It's much increased. I don't mean 100%. You're not going to have a situation where it works every single time, but you're talking about increasing your edge. So if you have the patience and discipline to wait for these high probability scenarios where lots of things come together at once, makes sense. So for example, let's just look here where I'm pointing, and we could look here or here. Let's just look here. And we ask ourselves, on this particular day, our bigger picture bias was up. So all things equal, we'd rather be on the long side. So with our big picture bias, yes. Do we have any market structure in terms of aggression bars or high velocity moves? Yes. I mean, we've had, this is the chart we've been building. We've had a high velocity move. All the, big aggression bars have been won, so to speak, by bulls. We have a level 3 buying aggression bar. What do we know about those? We know that the low of these typically hold pretty good support. So we do have some market structure in our favor. We have the filter. Yes, the filter is dark green or strongly bullish in this case, so that's in our favor. We have a support resistance zone. Yes, we have a green zone right here. The market should have some support right there. We have any confirmation like deceleration bar or additional aggression bars? Yeah, we have deceleration right here. So you can see this is a scenario where we have not just 1 or 2 pieces of evidence, but a confluence, 2, 3, 4, 5 pieces of evidence that all come together right there. Filter, bias, structure, confirmation, support zone. A lot of things are coming into place. Does that mean this is automatically going to win? Of course not. This thing could have just pierced right through there and gone south. But what it is telling you is you have a very strong edge there. Okay? You have a high probability situation. Same thing here. Green filter, green zone, bigger picture bias. Green filter, green zone, bigger picture bias. Deceleration, regression bars, high velocity move. A lot of evidence coming into play all at once. This idea of confluence. Okay? So I want to talk about some other important details. I know we're going to have some questions, some time for questions in just a moment here. But some of the common questions we'll get is what markets this can be used in. You can use this in any exchange traded market. Dave and I tend to focus on the indexes like the ES, but you can look at this on the NASDAQ, the Russell, the mini Dow. You can look at crude oil, gold, silver. You can look at corn, wheat, European markets like the Euro, like the DAX, Euro stocks. Look at bonds, look at the Bund. It's endless. Whatever, any market that is exchange traded, you can use this on. The same logic would apply. Same thing, which time frames can you use this on? The same logic would apply to any time frame that you want to use. If you're more of a day trader, you're probably going to be using a 1, 2, 3 minute type chart. If you are more of a position day trader, you might be looking at a 5, 10 minute chart. If you're more of a swing trader, probably a 10, 15, 30 minute trader chart. If you're looking at more of a position trade, probably the 60 minute chart. And for example, you saw the support resistance zones that I just showed on that chart prior. If you go to a 60 minute chart, you can have a scenario where the support resistance zones can last a month or two. Okay, so there was a move in the ES last year with a green filter off of a support zone. I mean, it was a 100-point move. Lasted a couple months. So I mean, you can take this and position trade with it. Same logic would apply to what you're doing if you're day trading. Okay. Now, Dave and I tend to focus more on day trading, but you can certainly use it for position trading. Same thing with those longer-term charts. You can also use that to give yourself a little bit of multi-time frame analysis. So, for example, even if you're a day trader looking at, say, a 2-minute chart, you can use a 30-minute chart or a 60-minute chart to give you a little bit of a broad scope of the market. Is the 60-minute filter green? Okay, great. Do I have a 60-minute support zone? Okay, great. That supports my day trading decisions. Okay. Next question. I think this is really important. Hopefully, you see we're not hype people, but this is really important. Is this the Holy Grail, or is this magic? No, of course not. There is. I think as traders, especially if you're new, we all go through this. We think there's some magic system or magic indicator, and if you're still going through that, great. It's kind of a process you have to go through, but hopefully I can invite you to look at it a little bit differently. There is no Holy Grail. The real Holy Grail is learning to better understand the market so you can make better decisions. What this is a tool. It's giving you, really unique, really high quality, real-time, true, market-driven information that then you use as a trader, and we help you with this, but as a trader, you use this to make better decisions so you can make better sense of the market. Better decisions lead to better results. Okay? And again, this is not for people who are looking for that, who are still on the search or the quest for that magic indicator. This is really good information, but it's a tool. It's something that you can use to increase your edge. And hopefully, this is for people that get the power of that get the idea that if you can just make incremental improvements to your edge, you're going to get much better results. Okay? So now, with this, if this is something that resonates with you, this has not really been intended as a sales webinar. We're just trying to offer education. We're trying to show you this tool. Hopefully, some of the concepts about process thinking and how you manage your exits and about thinking about context before trade setups. Hopefully, you've gotten some education, even if you have no interest at all in this particular tool. But with that said, Dave and I have been talking a little bit about some ideas, and we're going to offer an experiment if this is something that you like, if this is an idea that you like. Normally, if you go to our website, you can see this. You have an option to buy it for $2,000, or we have some payment plans where you can pay over time that start basically at about $800. And it's a great deal, but today we wanted to try something new. We're considering doing this. We know that what we're going to do here is have an option for $150 monthly lease. And I want to explain this a little bit. Hopefully this makes sense. Why we're doing this, we know that there's a lot out there. You've probably been through the ringer. We hear horror stories all the time. Okay, you might be hesitant to shell out $2,000 or even $800. So we're offering this so that it's kind of low risk outlay. You're not putting much cash out there. We're not fans of, tire kicking, free trials. When you're with us, you're with us. We're going to give you full support. So it's not like that. We also think it's important, sometimes you see a 7-day trial or a 2-week trial. This is for someone who really wants to dig in, get their hands dirty, so to speak. Look at it for a full month, okay? It's going to give you you're a full member, okay? This is not some trial membership. You're a full member. We're there to support you. We'll help you remotely. Once you're in, you're in. That's with us. If you love it, if things go very well, that's great. You can either continue on the monthly option, the monthly lease option, or if you want to upgrade to a purchase, we'll give you credit for that, no problem. So things go well, which I would expect, you keep going with it, or like I said, upgrade. If you decide that it's not for you, or if you're struggling for some reason, well, first and foremost, I would want, a week or two in, if things aren't going well or you're not understanding something, please let us know. Just about anyone that understands what this is and how it works does see an increase to their edge, does find benefit from this. So if you're not for some reason, by all means communicate that with us and we can probably help. But if for some reason you determine that this is just not for you, it's just not helpful for you at all, that's fine. You just let us know. We'll cancel. You're not going to get charged again. Okay, so the way I would look at this in terms of, what's the return on the investment for what your time is, for the money you're spending, the way I look at this is you don't have to risk a lot of money. You don't have to come $2,000 out of pocket. You get to try this for $150. Okay? And even if it's not for you, I give you my word, and my word's important to me. I give you my word that you will at least get $150 out of it, just out of education worth of value in this. You just will. There's a lot of good education in our site. We talk with you every day. We're there to email and talk and on the phone and do live sessions. You will, I promise, get $150 worth of education. And another way to think about this as well is if you can just, even the smallest trader, if you can just avoid just once the whole month, if you can just avoid one bad trade because of this software, or if you could get into just one additional good trade because of this software, it pays for itself. So like any good trader, you want to think about what your risk is versus your reward and what your return on investment will be. So risk is very low. Worst case, you're out 150 bucks, and I promise you, you're going to get that much value, and you're going to easily be able to get a return on your investment from your trading on that. Reward is you find a tool that really helps you for the long. So if that's something that's of interest, you can go to this link right here, which is daytradethemarkets.com/1, the numerals 150.htm. Get going yet today. We can help you get set up. If you have other questions, again, I'm not trying to push this. This is not meant to be hard selling. If you have other questions, if you want to look at a demo, whatever the case may be, just email us, info@daytradethemarkets, or give us a call, and we can answer any questions you might have. But I just wanted to kind of try this experiment. If people like this idea of like getting in on board for low, we're thinking about doing this more on the public side of our site. So it's a genuine offer. Hopefully, it's a great opportunity. It's never been offered like this before. So hopefully you take advantage if this is something that was of interest to you. So we have a few minutes here for some questions and answers. Let us, if you have some questions, go ahead and type them in. But again, if you have a more thorough question, just send an email or give us a call, and we'll get back to you. Platforms. At this point, we're on NinjaTrader, and let me explain why. If you're familiar with NinjaTrader, great. If not, please hear me out on this, because there's a really interesting way that you can do this, even if you use TradeStation or Signal or whatever the case may be. One of the great things about NinjaTrader is that you can use it free for charting. Okay, so you don't have to pay NinjaTrader anything. You can use it for charting. What you do have to do is get a data feed. You can either use, if you have like TradeStation or eSignal, you can plug that data feed right into NinjaTrader. Or we work with several different brokers who offer data feeds for free, and they do it because they know that if they offer this, enough people are going to end up becoming their clients, even if you don't. Okay, so there's a way to get an absolute. You can use NinjaTrader for free. You can get a totally free data feed. There are additional options as well. But you can use this for free, get a free data feed, and simply have some new chart or charts, however many you want to use, They happen to be on NinjaTrader. But other than that, you can keep everything the way you have it right now. You can maintain your trading on whatever other platform you're using, use whatever broker you want to trade with. So nothing has to change, and it doesn't cost you anything to use the NinjaTrader. And by all means, then you can. I saw another question. Lost my train of thought. I don't know. Let's see. If you have any trouble with getting it set up or anything, just let us know. We can help remotely. I can explain this more thoroughly in terms of how this works. It's something we do all the time with people. It works very well. Question, looks like market delta. Can you compare and contrast? Yeah, there is some similarity. I think we've taken it to the next level from market delta. Market delta is giving you some raw numbers. We're taking some of the concepts that they have in market delta, and we're also adding some additional components like velocity, range, volume, some other things that are beyond order flow, and we're also putting it in a more relative sense and making it more easily viewable visually. Not only that, there's also trade setups, a lot of more support. We're more of a community, that sort of a thing. So market delta is great. I think we've taken it to the next level. Let's see. Do you trade the markets all day? If not, what times are best? That's a totally personal question. One of the great things about this software, we have people that just trade the mornings, just trade the afternoons. Some people trade all day long. Some people, you can even look at this overnight if you want, and it actually works pretty well in the overnight. It's kind of a personal thing. One of the nice things about this software is that, a lot of times you talk about the lunchtime doldrums. Well, but other times the market really moves during lunch. What the nice thing about this software is that, excuse me, is that if nothing's happening, it's going to tell you that. It's just going to be black bars. Nothing's going to happen. But if things are happening, no matter what time of day it is, you're going to get notified of that. You're going to see that in what's going on in the chart. Okay. Let's see. How long can you lease it and get the credit you pay monthly if you decide to purchase? Give you, for this webinar, we do 2 or 3 months. That's fine. We'll say 3 months. Full credit toward a purchase, no problem. Is there a trade room? We don't do a full-time trade room, but we do some live trading sessions with our members, live education sessions, do a lot of support, and that's going to be even picking up this year. So there's quite a lot of additional education. That's an important point. We are really big on helping people on customer service. You don't just buy this and you're on your own. And obviously it wouldn't make any sense for us to offer this rate that we're offering right now on a monthly lease. We're not going to take care of you and help you. We might as well just go a hard sell and try to sell it for, you see people selling stuff for $5 grand, $8 grand. That's not our thing. Let's see, we have to wrap up in 3 minutes. Let's see. Someone saying level 3 aggression bars might not mean anything because it could mean a trader trying to close this position. Well, don't really agree there, John, because this is collectively in the market. You'd have to be an extraordinarily huge trader to, on your own, close out your position and cause a level 3 buying or selling aggression. This is collectively looking at the market as a whole. And yes, you could have some huge institution closing out a trade, but that's good. You want to see when that happens because that's going to move the market. When you get a level 3 aggression bar, it's not just some trader. This is a major market event that you want to pay attention to. So, will it work with Renko bars? Or same question would be tick bars, range bars. That's a very common question. This works on time-based charts, and let me explain why. Even if you're a tick trader or Renko or volume trader, this still makes sense. What we're doing is we're doing a lot of relative comparisons, again, between order flow, aggression, volume, range, that sort of thing, and we need a constant. So we've used time as a constant. That's the first thing. With that said, a lot of people that use this use tick charts. They keep looking at what they're using, and you're just getting a fresh perspective. You're getting a new look with a time-based chart, and the combination of those two things, I have rarely, if ever, seen a case where if you didn't add this component to what you're currently doing, it didn't help you. And again, if you think about it, if it just helps you one time a month, it pays for itself, and it's going to help you more than one time a month. So hopefully that That makes sense. So, is the full cost of the software $2,000? Any other charges? No other charges. No account maintenance. No hidden fees. No nothing. Hopefully, you can tell we're pretty upfront guys. If you buy it for $2,000, it's yours. You know, Dave and I live on opposite sides of the continent, so you know there's not much risk that we're both going to get hit by a bus on the same day. And even if we did, even if we both got hit by the bus on the same day, we set your software to work as of right now for like 10 years. So, you know, you're going to be fine even if we, you know, close up shop tomorrow, which we're not going to do. Once you buy it, it's yours. You're in. Any upgrades? Yeah, no charge for any upgrades. We just had an upgrade a couple months ago. You know, if you're a member, you get any upgrades we do completely free. It's all included. Looks like we are out of time. I'm getting a note that we're out of time. Going a minute over. I apologize about that, Kevin. But by all means, please send us an email at info@daytradethemarkets.com. Give us a call if you have any questions at all. We're happy to get back to you. But you know, Dave and I would really like to thank you for taking the time to join us today. Hopefully, you got something out of this. Hopefully, we can work with you down the road as well. And by all means, let us know questions that you have. And hopefully, we'll be working together soon. Okay. Thanks, Kathy. Thanks, Kevin. Thanks, everyone, for coming. Really appreciate that. Have a